So we saw briefly before that in the case of our newly opened bank, that reducing reserves allows us to increase our loan portfolio, improving profits. So we need to ask ourselves whether it's prudent for banks to lower reserves to the minimum requirement posted by the central bank, or if reserves were not required, whether it would be prudent to have zero reserves in order to boost profitability. After all, reserves don't really earn any interest, and funds can be better deployed elsewhere in our loan portfolio. However, this is not the case. Banks need reserves for two reasons: for the purpose of liquidity and to honor loan commitments. And let's look at both these scenarios. So we saw in the warehouse banking section that deposits are close to cash. They are either demand or notice deposits that are also called fixed deposits that can be converted to cash anytime. However, banks accept deposits as well as withdrawals, and most of the time pooling nets off the inflows and outflows of deposits. Let's understand how pooling works by taking an example. So at the inception of a bank, when a bank has a few depositors, it is very difficult to predict the behavior of each depositor, whether they will withdraw or deposit on a particular day. However, as and when the deposits grow to a sizable amount, the behavior of a large number of depositors is much easier to predict. Now let's assume that the deposit size in the Bank of Metrocity has grown to 10,000 depositors with an average deposit size of $1,000, making $10 million in deposits. Now the Bank of Metrocity keeps data of the number of deposits and withdrawals done daily and finds that the deposits range between $1 million to $3 million each day, and withdrawals range between $1 to $3 million daily also. On an average, daily deposits and withdrawals tend to offset one another. Only on a rare day will withdrawals exceed deposits by a significant amount. Let's say the bank's statistical department says that the probability of the withdrawals exceeding deposits by more than $3 million is very low. Statistically, maybe 2 to 3 standard deviations from the mean. This means that the $5 million reserves is sufficient for the Bank of Metrocity to meet its liquidity demands. However, there are times when withdrawals will exceed deposits more than reserves, and there are ways for the bank to handle it. The bank cannot risk a bank run at any costs. That would affect the credibility of the bank. The bank also cannot default on the reserve requirements posted by the central bank at any costs, as the central banks post stiff penalties. Now, pooling works because the depositors are diversified, and so is the case with loans. The borrowers are also diversified. If the behavior of the depositors were alike, the probability that the depositors would withdraw together would be high. Diversification of loans and deposits is very important for the bank and also for pooling to work. Netting is the second reason why pooling works. This is because netting offsets the withdrawals and deposits, thereby reducing the number of transactions that need to be actually executed. Let's take an example. For example, if the total deposits flowing into the Bank of Metrocity was $1 million for the day, and the withdrawal was $1.3 million, then the Reserve Bank of Metrocity would reduce BOM's account by $0.3 million by the net amount. Now the second reason why banks need reserves is to be able to accommodate new loans. Banks provide their customers with lines of credit. So these are credit lines which are funded or non-funded credit. In the funded credit line, banks make loan commitments in advance to their customers. So let's take an example. The marketing department at BOM has been trying to get AAA customer to the bank to deal with the bank for a while, AAA finally agrees to bank with BOM and requires a $10 million loan commitment over 2 years. This means that AAA can draw down on the loan at any time during the 2 years. BOM has many such customers with loan commitments. If BOM kept the minimum reserves required by the Reserve Bank of Metrocity, it would not be able to honor any withdrawals by AAA without violating the reserve requirement. If BOM violates the reserve requirement, it would have serious consequences for the bank. BOM would therefore need to have excess reserves in excess of the required reserves. However, the opportunity cost of excess reserves is high since the funds could be better utilized or deployed elsewhere. So that brings us to another concept in banking called the asset liability management, which is also crucial for us to understand when understanding the monetary policy.